Preparing for a banking interviews at Qatar National Bank QNB interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work at QNB. I'd position myself as a finance professional who combines technical discipline with client awareness. QNB appeals to me because it is Qatar's leading bank with a strong regional footprint, so the role offers both scale and learning. I would link my academic background, internship experience, and analytical skills to the specific position, then explain how I can support reliable execution, risk control, and strong customer service in a highly regulated banking environment. While answering, focus on a tight professional story: education, relevant experience, banking skills, motivation for QNB, and the value you bring to the specific role without sounding generic. Question 2. What do you know about QNB's business and market position? QNB is Qatar's flagship banking group and one of the strongest financial institutions in the Middle East and Africa. I would describe it through 3 lenses: dominant domestic franchise, diversified services, and international reach. Its businesses span corporate banking, retail, treasury, asset management, and Islamic banking through affiliates. The bank's size creates responsibility, maintaining strong capital, liquidity, compliance, and customer trust, while supporting Qatar's economy and cross-border clients. Make sure to cover QNB's position as Qatar's leading bank, its regional and international footprint, major business lines, and why scale, stability, compliance, and customer trust matter in banking. Question 3. How would you assess the creditworthiness of a corporate borrower? I start with repayment capacity, not collateral. For a corporate borrower, I review the business model, industry outlook, management quality, audited financials, cash flow, leverage, liquidity, and debt service coverage. Then I assess facility purpose, tenor, security, covenants, and group exposure. A profitable company can still be risky if cash conversion is weak. My recommendation should clearly state the risk, mitigants, pricing rationale, and monitoring triggers. In your answer, talk about repayment capacity, cash flow quality, leverage, collateral, industry risk, management quality, covenants, and how a credit recommendation balances client growth with the bank's risk appetite. Question 4. What is net interest margin and why is it important for a bank like QNB? Net interest margin is the spread a bank earns between interest income on assets and interest cost on funding, relative to earning assets. For QNB, NIM matters because lending, deposits, and treasury assets are core drivers of profitability. If funding costs rise faster than loan yields, margin compresses. I would also connect NIM to asset mix, deposit quality, rate resets, competition, and credit risk management. Be sure to mention the formula concept: loan yields, deposit and wholesale funding costs, asset mix, interest rate sensitivity, and why NIM is a core profitability measure for commercial banks. Question 5. Explain International Financial Reporting Standards 9, expected credit loss provisioning, in simple terms. International Financial Reporting Standards 9 moves banks from an incurred loss model to expected credit losses. In practice, exposures are grouped into stages. Stage 1 books 12-month ECL, Stage 2 books lifetime ECL after significant credit deterioration, and Stage 3 covers credit-impaired assets. For QNB, this affects profit, capital planning, and risk appetite. Good answers mention probability of default, loss given default, exposure at default, forward-looking macro assumptions, and governance. While answering, focus on International Financial Reporting Standards 9 staging, expected credit loss components, forward-looking assumptions, significant increase in credit risk, and the link between provisioning, profitability, capital, and credit discipline. Question 6. Which financial ratios would you review when analyzing a bank? Bank analysis is different from industrial company analysis because deposits and loans are the operating business. I focus on profitability, asset quality, capital, liquidity, and efficiency. Key metrics include return on equity, ROA, cost-to-income ratio, NIM, non-performing loan ratio, coverage ratio, CET1 or capital adequacy, loan-to-deposit ratio, and liquidity coverage. Together, they show whether growth is profitable, well-funded, and controlled from a risk perspective over time and cycles. Make sure to cover bank-specific ratios rather than industrial company metrics. NIM, return on equity, cost-to-income, NPL ratio, coverage, capital adequacy, liquidity, loan-to-deposit ratio, and trend analysis over cycles. Question 7. How would you handle a demanding or upset banking customer? With a difficult customer, I would stay calm, listen fully, and separate emotion from the issue. First, I would confirm the facts: account, transaction, timing, product terms, and any bank policy involved. Then I would explain the next step clearly, escalate if authority is needed, and follow up. In banking, service quality is not just politeness. It protects trust, reputation, and long-term client relationships daily. In your answer, talk about active listening, staying calm, confirming facts, explaining policy clearly, escalating within authority limits, documenting the issue, and preserving the client relationship. Question 8. What AML and KYC red flags would you look for during client onboarding? AML and KYC are about knowing whether a client's profile, money, and activity make sense. Red flags include unclear beneficial ownership, complex offshore structures without rationale, inconsistent source of funds, unusual cash activity, sanctioned country links, politically exposed persons, and transactions inconsistent with expected behavior. At QNB, I would not treat this as a box-ticking exercise. I would document concerns, escalate properly, and protect the bank from regulatory and reputational risk. Be sure to mention beneficial ownership, source of funds, sanction screening, PEPs, unusual transaction patterns, documentation quality, escalation procedures, and why AML control protects both QNB and the financial system. Question 9. How do rising interest rates affect a commercial bank's profitability and risk? Rate movements affect both earnings and valuation. If interest rates rise, a bank may reprice floating rate loans faster than deposits, improving NIM, but funding competition can later squeeze margins. Higher rates can also pressure borrowers and increase credit risk. On the balance sheet, fixed income securities may lose fair value. So I would discuss asset liability duration, deposit stickiness, hedging, loan mix, and stress testing for resilience. While answering, focus on both sides of the balance sheet: asset repricing, deposit beta, funding costs, securities valuation, borrower stress, hedging, and asset liability management discipline. Question 10. What is Basel III capital adequacy, and why does it matter for QNB? Basel III is the global framework that sets minimum capital, leverage, and liquidity standards for banks. Capital adequacy matters because it shows how much loss-absorbing buffer QNB has against credit, market, and operational risks. I would mention CET1, Tier 1, total capital ratio, risk-weighted assets, LCR, and NSFR. Strong capital supports regulatory confidence, credit ratings, client trust, and the ability to grow without taking excessive risk. Make sure to cover capital adequacy, risk-weighted assets, CET1, liquidity standards, leverage, regulatory confidence, and why strong capital allows QNB to absorb losses and keep lending. Question 11. A corporate client's cash flow weakens after loan approval. What would you do? If a borrower weakens, I would not wait for default. I would review updated financials, cash collections, covenant compliance, utilization, collateral value, and reasons for deterioration. Then I would classify the exposure appropriately, discuss with relationship and credit teams, and consider restructuring, tighter monitoring, or exit. The key is early action. Protect the bank while giving a viable client a realistic path to recover successfully. In your answer, talk about early warning signs, covenant breaches, updated financial analysis, credit classification, collateral review, escalation to risk teams, restructuring options, and protecting the bank before default occurs. Question 12. How do you ensure accuracy when processing transactions, reports, or reconciliations? Operational accuracy comes from process discipline, not memory. I would prioritize time-sensitive and high-value items first, follow maker-checker controls, reconcile against source documents, and investigate breaks promptly. If I spot an error, I would disclose it early, correct the root cause, and document the fix. In a bank like QNB, small processing mistakes can create client, regulatory, liquidity, or reputational consequences very quickly if unmanaged. Be sure to mention prioritization, maker-checker controls, reconciliation, documentation, escalation of breaks, root cause correction, confidentiality, and why operational discipline matters in a high-volume banking environment. Question 13. What role does digital banking play in QNB's future growth? Digital banking is now a core competitive lever, not just a convenience feature. For QNB, strong digital channels can reduce branch pressure, improve customer experience, deepen data insights, and support faster onboarding and payments. The challenge is balancing speed with cybersecurity, fraud monitoring, uptime, and regulatory compliance. I would show interest in using technology to make banking simpler while preserving trust and control at scale. While answering, focus on digital channels, customer convenience, cost efficiency, data analytics, onboarding speed, cybersecurity, fraud controls, uptime, and the balance between innovation and regulatory compliance. Question 14. Why should QNB hire you for this role? I would answer this by matching my strengths to the job, not by making generic claims. I bring strong numerical ability, attention to detail, client awareness, and willingness to learn QNB's systems and controls quickly. I am comfortable working under deadlines because I prioritize, communicate early, and check my work. Most importantly, I understand banking is a trust business, so I take accuracy, confidentiality, and accountability seriously. Make sure to connect your skills directly to the role: analytical ability, accuracy, client mindset, teamwork, pressure management, learning agility, ethics, and respect for banking controls. Question 15. Where do you see yourself in 5 years? And how does QNB fit into that plan? In 5 years, I want to be a dependable banking professional with deeper expertise in credit, risk, operations, or relationship management, depending on the role. My immediate goal is to master the fundamentals, deliver accurately, and earn trust from seniors and clients. QNB's scale makes that realistic because it offers exposure to large clients, disciplined governance, and regional opportunities. I would emphasize growth through performance, not entitlement. In your answer, talk about realistic career growth, mastering the current role first, building technical banking expertise, earning trust, and aligning your ambitions with QNB's long-term platform. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.